Welcome to Philly Fortune Talks with your host, Jake Penny, where the city's brightest minds share the secrets behind their success. Are you ready to be inspired?
Imagine securing consistent, high-yield returns without the volatility of the stock market. Today, we explore the journey of Craig Eppler, founder and CEO of Eppler Capital Funds. With a decade of investment experience, Craig launched Eppler Capital Funds in March 2023 to offer investors secure promissory notes with fixed returns up to 9% per year. Craig's career began at Vanguard as a derivatives analysis before he became the senior portfolio manager at Hoover Financial Advisors. His experience in public and private market strategies and his real estate investments have established him as a leader in asset management. Craig, it's a pleasure to have you on the show.
Quite the intro, Jake. Thanks for having me.
Absolutely. So you founded Eppler Capital Funds in 2023. Can you share, kind of what motivated you to start your own firm, coming from, previously different financial vehicles in the past?
Sure. Yeah, I'll start. I think it's important to kind of hear the story of where it all started to kind of see where I'm going and kind of how I made that decision. So like you just stated there, I started my career at Vanguard, worked at the big corporation for 2 years on the trading desk, dealing with stuff that sounded sexy and what I thought I wanted in college. But at the end of the day, didn't really enjoy being part of a mega firm and being more of a number instead of really having a huge impact at the smaller client level. So left there in 2017 to join a firm that you stated, Hoover Financial Advisors. I was an analyst there for a couple of years and moved up the ranks to the senior portfolio manager, like you said, but really we got gobbled up with that firm by a firm backed by like private equity money. So I went from a 20-person firm to a 2,000-person firm, which ended up feeling more of the same of Vanguard. Not quite as big, obviously. We still had the kind of homegrown feel, but more of the same there. But that's really where I cut my teeth in kind of the Wall Street stuff, right? The stocks, bonds, mutual funds. But we did a lot of privates there too, which was my favorite part. So 2017 to 2019 is when I first started buying real estate. Got bored during COVID, and frankly, that's when I bought a lot of it. Got the timing really right there and ended up buying up 44 units out in central Pennsylvania, just because at the time that's all I could afford in terms of price point. I mean, back in the day, I was getting doors for 50 to 75 grand like a pop out there, versus Philly is a little bit different. So that's kind of where I first got into the private market scene. And really at my old job, I didn't deal with clients directly. I was sometimes brought into meetings to talk about portfolios. But what I heard over and over and over again was really that clients, not that they didn't care, and these are probably the 60-plus-year-old clients, I would say $1 to $5 million net worth, worked a career their whole life, but they really just wanted kind of consistency, right? They didn't care for the ups and downs of the stock market. They just wanted consistent income about what they were making in their job so they could do whatever they wanted the rest of their life. So I'm like, all right, these private investments that I have, and I had kind of dabbled in different things outside of real estate that I really liked as well, to me were a lot more consistent and spit off a lot more income than the Wall Street stuff that I was used to and that our clients were used to. So I'm like, all right, if I can take this kind of very traditional Wall Street type of wealth management stuff and combine it with the private asset world, I think we have something. So that's where I kind of created what I have now. It's a promissory note fund. So the idea is really simple. I give a simple 9% return, which if you look back is what the S&P 500 has given you for the last 50 years. So I'm going to give you the S&P like return in an income form, and it's paid monthly. So I've found out that a lot of people like that monthly kind of feel of a paycheck hitting their account, instead of a quarterly or yearly or all the money at the end. So that's kind of how I structured it, and started in March of last year and then ran it parallel to my 9-to-5 job until I felt confident enough to leave that and do it full time at the start of this year. So I've been full time now for almost 7 months and things are going well.
That's awesome. I preach that day in and day out is secure, predictable, and consistent returns through Main Street instead of Wall Street.
Yeah.
Wall Street is good if I feel like if you're a hedge fund, right? You have tons of money, black box shit, or like you invested in the 80s and 90s and or even before that, and you were able to take that curve of all the growth in the companies. Now it's just like, I feel it's gambling. The 401k, not even the owner that made the 401k,
Mhm.
the person that made the 401k doesn't even invest in a 401k anymore. He doesn't even believe it because of all the stuff that changed in it. And then
Yeah.
it's just like a bank account for the IRS at a later date. And people are like, oh, like, I have this 401k. Cool. That's awesome. But you built a nest egg, right? More like you built a goose, right? And
Right.
now you're going to pull all the eggs out of the goose, and then the goose is dead. It's like, why don't you keep the goose and have it spit you golden eggs forever? And that's
Mhm.
like what the promissory note fund that you're doing is like, make income, because if you keep growing, drawing on your nest egg, it's going to be gone.
Right. And I'm not fully against the stock market. I still have stock market holdings myself. But to me, I would rather have more than half the portfolio in these private assets. I mean, right now, if you look at it, the average client that I have still has the vast majority of their like a portfolio in like the public markets, which is fine. But I'm always trying to, why don't you give more to the public, to the private side. So,
Absolutely.
mhm.
So, Epler Capital Funds focus on investing in promissory notes. Can you talk about like some key strategies that have been essential for achieving consistent returns for your investors?
Yeah, so I've been around now for just over a year. In the fund world, track record is everything, as you know. People want to trust you. That's the biggest thing. Um, so for me, I'm not running this to make 40%, right? I'm running this to make, I mean, my goal is to make obviously a spread because we don't charge any fees. Um, so anything over 9 is what the fund gets to make. But I'm running this much more conservatively than a venture capital fund, or something that's really kind of shooting for the moon here. I'm investing in small to mid-sized businesses that spit off consistent cash flow, and these are old school kind of businesses. I'll just give a quick example. And these are kind of niche projects that some people might ask that, like, I mean, how the hell do you find these? But it's just all about your network and who you know. And as you get some of these groups, they all know each other, and you just kind of build it from there. But as an example, our biggest holding right now is in this airline group. So think of 30-plus-year-old airplanes that are past their useful lives. These guys bring down these old airplanes to their warehouse. They have their team part the plane out, and then use the plane's parts to lease or sell back to the like airline companies. And the spread on that is pretty awesome. I don't think airlines are really going anywhere. And the guy who's been doing this has been doing this for 25 years. So it's not a new business that just started. Um, but my kind of contact that I knew came to him and said, "Hey, you have a real business here. Instead of you doing it by yourself, why don't you kind of pour some money on this? Hire like this team. Build up the warehouse, put this stuff online." This guy was doing it all off of his phone, right? So he brought it online. Now they have the specs. It looks pretty online, so people can see what this guy's doing and say, "Okay, I need a left rear engine," or whatever it is. Um, anyway, so the fund has a first lien, if you're familiar with the like in real estate terms, there has a first lien on all the airplanes and all the parts. So if stuff hits the fan, then the fund owns airplanes down in Florida. Not that I want to kind of take them up on that, but there is a hard asset, and that's like really important to this because that's what I learned from like in real estate is you want to have a hard asset, something that you can draw on. Or it can be intellectual property. I try not to do that, but I really try to do some sort of hard asset that's backing all these investments. That makes sense?
Absolutely. Yeah. Tangible assets, something you can touch, feel, see with your eyes. If you're having a bad
Yeah,
day, you can kick it if you want to.
that's right.
uh, can you describe any particular challenging investment scenarios and how you successfully navigated through it?
Yeah. I'll give you a horror story. This is with the fund, but in my personal investing, this is when I was new to real estate, still learning through all the kind of podcasts and stuff. But I got in an investment. Thankfully, it was a smaller amount of money at the time. But I was in second lien. Um, they were giving a pretty juicy return, so I'm like, what could go wrong, right? I didn't really understand fully what that meant at the time. Um, the guy who had the property realized the property wasn't worth what he thought it was. And as a second lien holder, you're kind of SOL if that happens. So I ended up losing that entire investment, which was definitely a gut punch at the time. But I think I preach that a lot too, is like never put all your stuff or never put all your eggs in one basket because if I would invest in my net worth, then I probably wouldn't be sitting here today, right? It was a hit for sure, but it didn't kill me. So be able to take the punch and kind of keep going. I'm not sure if that's the story you're looking for, but that is still my
Oh,
mind. I lost 10 grand in that, which
it
at the time was a
definitely
lot of money. It hurt, you know.
it definitely is, you know. It's also, you know, it can go hand in hand with like stick to what you know. Like if you know real estate, stick to real estate. Don't go and venture out because there's this new sexy object, shiny shit
Shiny object
out
syndrome. Yeah.
there. You know,
Yeah.
I did that, you know. When like Bitcoin mining became a thing.
Right.
I invested in like almost $200,000 into this Bitcoin mining operation. That I never even seen it. Like I never even seen it. You know, there's a bunch of people we're talking about. I'm like, oh my God, it's spitting out crazy cash flow per month, like 18% per month. And I was like, dude, this is amazing. And I was making like, you know, 4 grand a month cash flow depending on like Bitcoin where it was. And I was like, damn, this is awesome. All of a sudden, SEC shut the whole thing down. I lost like $100 some thousand overnight. Nobody like you weren't getting it back. So it's like more of the story. One, know your shit, know the asset,
Yeah.
make sure it's tangible for sure, and you actually have some real backing on it, like security documents, whether that's a, you know, private placement memorandum, subscription agreement, promissory note, mortgage, confession of judgment,
Right.
whatever it may be. But yeah, no, that definitely makes good sense. Well, not good sense. Makes sense. That's bad, but it makes sense.
No, but I think that's a good point, right? I mean, if you ask a fund manager, tell me something that like happened that didn't go well, and there's nothing that happened poorly, to me, that's a red flag that like they haven't experienced anything that's gone poorly and like they don't know how to navigate that, or they're just lying to you.
Yeah.
Those are the two options to me because if you've been in the game long enough, like like there's stuff that just doesn't like go right all the time. And that's
Uh,
something you learn from, I think.
Yeah, absolutely. Even if like, you know, you're in it and you're in control of the deals with real estate, like, hey, you're a fix and flipper,
Yeah.
you know, and you have 5 deals going at once, say. This is kind of like my story when I first got started.
Yeah.
Um, you know, the contractor burns you on multiple different projects because you have him on all projects. The next thing you know, he runs out with all your money and leaves you high and dry. Well, your family tells you to, you know, roll up your shirt and sell everything, take it on the chin and pay your investors back over the course of your life and go get a job. And yeah, I did not do that. I stuck with it and learned how to use tools and shit until
Yeah.
12 o'clock at night, every single night until I was done. But there's shit can happen.
Yeah.
And, you know, you have to know how to navigate it for sure.
Right. And just use everything in your control and your power to make sure that stuff doesn't happen. And honestly, I've learned a lot of lessons from that. And frankly, everything that's in the fund right now is stuff that I know the operators well. I have my personal money in there, stuff that I've put my own money in and gone full cycle in prior to actually starting this fund. So that was important to me. I know that I can't do that forever. And as I grow, I'm going to have more trust in these other groups. But for now, everything that's in the fund are guys and gals that I've used for the past 5 years. So
Yeah, that's amazing. You definitely have to know the operators, trust your operators, have a track record, and not just go willy-nilly blind investing in
yeah,
other people. Because a lot of people are right now. You know, a lot of these big time guys are going under in syndications and, you know, that have been the trusted person.
right.
They're getting knocked down because they're trying to squeeze pennies. They're jumping over quarters to pick up nickels.
Yep,
And just to get deals done, just to add doors or add whatever it is to their portfolio. And it's like, don't make a deal work if it don't work. Shoot
right.
that behind the shed and just move on to the next one.
Agreed.
Um,
Yeah.
but how's your background in derivatives and portfolio management influence your leadership style at your fund?
Yeah, I think I add a unique aspect. Like a lot of guys in this space have only dealt with real estate, have only dealt with private assets. I can actually, in my head, I can see like the other side and like see the bull case for just investing in stocks or see the bull case for just investing in bonds. And kind of speaking to that, kind of mass affluent is what we call it in like the financial world, right? That $1 to $5 million client. Um, I think I really learned that from my old space, and to be able to kind of combine those two worlds, I think helps me a lot. As I'm trying to raise money, it's tough, as you know, to raise capital when you're young, when you're a newer fund. But I think being able to understand like people's problem, right? You have to say like what's people's problem, and how am I solving that? Because that's really the issue, right? You can give this awesome return, but if you're not answering their questions and what their fears are, then kind of what's the point of it? So I think that's the best thing that I learned from my old world, and how I've really been able to apply it to the kind of clients that we have now and kind of who I've been talking to.
Yeah, and that's awesome that you also have like the background of being, a Wall Street guy, financial planning, derivatives, all that stuff, and you're able to bring it to this side and be like, okay, well, this person's probably thinking like this. They have these problems because I've seen it, and we're
Yeah.
solving it over here with the Epler Capital Fund. So
Yeah, I mean, I've gone all the way from like I'm Vanguard, like my first job. Part of my job was at the end of the day, they had to track the index to a T, right? So part of my job was to look at their excess cash and buy billions of dollars of E-mini futures, which is so different than what I'm doing now. But you see like, the extremes of each of these sides, right? So anyway, so it's cool to see the different sides of the market and see what I like and don't like, and be able to pick from that too. Because my old job too, I was able to kind of see different sides. I was able to see the private real estate. I was able to see stocks. I was able to see private equity. I was able to see promissory notes, all these different things, and say, that's the one that I like. I think that fits me the best.
yeah, yeah, that's cool that you had that past experience. I always like hindsight 2020. I'm like, oh, like I should have feel like I should have went down more traditional route to learn that stuff and then maybe, catapult into what I'm doing to just have a better understanding of like real life. It's one thing when you're reading it from a book. It's another thing when you actually work for a firm and you're in it and you're like in the grind and
Yeah,
learning and actually doing. Because textbook is textbook. Like it's just
that's what we say.
uh, you know, it is what
Nothing's
it
much in real
is.
life.
It's worth the paper, the weight that it's on, or whatever the
Yeah.
paper that it's on. Um, so like balancing your personal commitments, and professional commitments can be kind of challenging at times. So, what daily habits or routines help you stay focused and effective?
So I was a runner in college. I did track and cross country, been a runner my whole life. So I've been running a lot. I'm actually training for the Philly Marathon right now,
Oh,
in the
nice.
heat. But that's kind of what helps me keep me grounded. If ever, I mean, you know this better than anyone, right? When you're in a job, at least for me, everything was kind of like middle of the road, even keeled. Now my highs are incredibly high, my lows are low, and I'm learning to kind of navigate that a little bit. But the running helps, right? It brings me down. Like if I'm feeling like really on top of the world, like the run is great. And if I'm having a rough day, then the run also helps me kind of say, okay, things aren't that bad. You can think through it, gives you time in your head. So for me, that's one thing. I journal every day. Just for 5 minutes, but that little bit helps me kind of clear my mind and say, okay, these are the top three things that I need to do today. It just keeps my mind right. So I'd say the journaling and the running for me are really the two big ones.
Yeah, I'm actually second day back in the gym.
There you
It's
go.
like 3 months. Uh, but no, like that's, a big thing of like having a clear level head. Like you said, you have amazing highs, but your lows are low too. And it's just kind of like this. And you
Day
have
to
to
day.
understand yourself and be like, okay, what is going to get me to feeling from this to feeling up here? And like self-care, self-love is definitely, the greatest thing, whether it's a run or going for a workout, journaling, affirmations, visualization, sitting in the sauna, whatever it may be. It's like, I've always, for me at least, it's always been like, if I own my morning routine, working out, reading, learning something, affirmations, journaling, um, I'm just in such a higher state throughout the day. And like those things that could potentially bring me down don't necessarily bring me down if I conquered my day, like, because then I'm like, I'm attacking the world instead of the world attacking me. I'm being proactive, not reactive. And yeah, I think that's like huge, huge. Um,
Yeah,
and
for me, it's that. I'm just like you said, like that morning routine really helps me get in like the mode for work, right? And I don't know about you, but like for me, another thing is too, I have an office downtown here, and just like the act of walking to the office gets me out of like my home mindset and into like work mode, and then when I leave for the day, it gets me out of work mode and back to like being a good husband and everything like that. So like to me, just literally walking to the office helps me get out of my own head of like, all right, now it's also time to focus. So I don't know if that
is
makes sense.
your office in Philly?
It is. I'm Ninth and Market.
Okay.
Yeah.
Yeah, I always like envisioned as a kid to have an office in Center City because
Yeah.
like the energy, the vibe, the lights, the fast pace, it's like, and the walking. Just honestly, dude, I lived in Delaware County, but I would drive to Philly to go to the gym every single morning at 5 a.m. And after
Wow.
that, I would go and I would just walk around the city for a little bit and then head back to Delaware County just to get like that juice that the city gives you, you know.
For
It's just
sure. I
now
love it, man.
now I have a home office and it's, you know, it's different. But and I
But it's
well
different
not
rooms.
that I don't go to the gym in Philly no more. But yeah, I mean just the vibe that just walking around probably to the office gives you, you know, it's just like you get all amped up
Yeah.
for everybody else's energy. So that's really cool.
Yeah.
Um, you know, your firm emphasizes on stability and high income opportunities. Can you share an example of how your innovative approach has benefited your investors?
Yeah, so my clients sign up for a lot of trust, right? So for them, it's hey, you're gonna get 9%. You sign up for a 3 to 7 year term. They get to choose. I found out that was another thing that clients liked is instead of telling them what they
Mhm.
need, having them pick. Hey, I want a 5 year term. I want a 6 year term. I want a 3 year term. I can't really do my investments in under 3 years, to be honest with you. So that's why the minimum is three. Um, so that was part one. My biggest thing is finding the right projects to invest in. And just like the stock market, like you shouldn't have one project for the whole fund. So lots of real estate deals, lots of different deals that are out there you can invest, but it's usually in one building,
Mhm.
or one project or one area. Right now, the fund has 5 projects, and the goal is to get up to 10 to 15. So if one really kind of hits the fan, then there's others in there that are obviously making up for that. And as time goes on, a big question I get is, okay, so you have cash flow and you're paying us nine. So what happens if you're not able to pay us nine? And honestly, that answer is pretty simple. Is as times are good, and honestly, right now things are good, and we're getting some good cash buffer. I'm in the process of building that cash, right? So right now, as we said today, we have 4 months worth of cash that if we got no distributions at all from any of the stuff that we're in, that we could pay investors for the next 4 months. And the goal is to bring that up to 12 months. So again, it's really making this so it's a stable kind of like steady cash flow play in these businesses that just print cash. There's a lot of old school businesses that aren't sexy to everyone, but there's just like so much cash that spits off of them. It's crazy. So
Yeah. It doesn't have to be sexy and
not at
shiny.
all.
All it has to do is make sense and make dollars.
That's right.
You know,
Exactly.
and that's funny with like social media now. It's like, oh, it's got to be sexy for you to invest in. It's like, okay, well, what if you do something that's boring, like laundromats, you know, car washes, whatever it may
Yeah,
be.
stuff like that, man.
You know,
Yeah.
investing in old mom and pop businesses that are about to like close their doors. Well, they've been operating it from day one as kind of like a hobby, but it started to make money. So how can you go in there, build a business and make it efficient and scale it? So it's like nothing has to be sexy. Like, I mean,
No,
shit, real estate sometimes, a lot of times isn't sexy, but
most
it's
of
a
it's not.
vehicle to get you to where you want to go.
Right.
It's like,
Yeah.
hey, you don't have to love it. You don't have to like it. Just do it. And if it makes sense on the bottom line and it makes money, scale it.
And that's the thing, like with real estate too, right? Is like you always hear about the flips that go really well and you make 6 figures on this flip. But no one ever says like, the best way to build wealth like long term is just literally don't do anything. Just buy it and hold it for the next 30 years. And you're paying
Oh,
down the
yeah.
mortgage, you get the tax write-off, all the stuff that we know and love about real estate, right? There's nothing sexy about managing tenants, but that's kind of what gets you to the next level too.
Yeah. Yeah.
No
I
idea.
went from a flipper mindset, you know, from when I first started in 2016 to COVID hitting. And I was like, I don't know where this is going to go, like with the economy. I was like, I don't know how long I can keep flipping properties and still make a living and still
Yeah.
earn income. So I was like, I had seven properties at the time as rentals. And I was like, man, I got to really focus and double down on building a good rental business, good portfolio. And
Hmm.
fast forward, here we are, 2024, got like 100 properties.
That's great.
And the way I do it too is I do full gut burrs. So I do everything, redo everything to where I don't have any maintenance or very, very, very low maintenance for the next 10 to 15 years because I'm redoing all the mechanicals, all the roofs, et cetera, et cetera. But yeah, it's like flipping's cool, flipping's sexy, big paydays, you know, and as a young guy or, you know, a young girl, you know, big checks scream a lot at you. It's like, oh my God, this is wonderful. But it's like, what about the long-term money? Like too many people that I talk to that are like in real estate now and they're younger. I'm like, dude, just keep this deal, man. Just keep this deal, dude. It'll make you so much money over time.
Right.
I want to, $50,000 check or $75,000 check, $25,000 check. It's like, dude, just keep it. It makes so much money. You have it for pennies on the dollar. Why wouldn't you keep it?
Yeah.
But you can't make a horse drink from the water.
It's tough, man. And you did it like the smart way. So when I was buying real estate, I had the limited mindset a little bit. I knew enough to buy real estate, but I didn't know enough to make the properties nice when I bought them. So I'd buy them and just leave them as is. And it's been a year and a half long kind of like stabilization process to stabilize the full portfolio, honestly. Just because then when you turn them, then you have to fix them up, right? So that's what I'm trying to do right now. But it takes so much longer, and I think you did it the right way. And as I move forward, that's kind of my plan as well.
Yeah,
To do the Burr method.
it's definitely the right way of going and just make it as, best of a property that's possible based
Yeah,
on, how much equity you have in whatever the value is, et cetera, et cetera. Because that's where like the bad taste gets in people's mouth when it comes to single family and small multifamily real estate is that they don't go in and they don't update these properties and do the proper fixes and, spend the capex. It's like, then they get bamboozled with all these maintenance requests and everything, and it's a freaking nightmare. And it's like, well, if you did it right from the get-go,
right.
or if you just knew how to go about it, right? Because not everybody knows the right way, so they just think buy real estate and everything's fine and dandy. Um, yeah, you got to go in and just redo everything, and that's the way to do it, so you don't have headaches.
Right.
Nobody
You don't even need to
wants,
know how to do it. I mean, you kind of had to learn, right? Based on what I heard.
yeah.
Um, and I had to fire a bad like a property manager. There was a whole thing with that. So I have a great property manager now. I trust him with my life, with the whole portfolio. He's doing a great job, right? So like finding the right person, even if you don't know how to do it, is hugely important, obviously. Because I'm not managing 44 units, you know.
I totally agree with you with that. I had a similar experience in the beginning as well. I had an unfortunate event with a property manager, and that was only at 7 units. And it made me pull back the onion and learn the business too. And now me and my wife, we manage, well, not me, she manages all the properties. Um, so we have it fully
That's a
integrated
good wife,
and
my friend.
everything. And she probably spends 2 hours, maybe tops 4 hours a week on the whole portfolio. But we have an awesome team of guys that are contractors at all times doing all of our properties anyway, like doing
Okay.
the burrs. So it's like, oh, if something pops up, it's like, okay, jump off that project, go over there real quick. They're already in the area, because we stick to a specific pocket.
Got
Um,
it.
but if you do have the ability to do that, I mean, that saves 10% on your total cash on your revenue per year. Like that's a lot of money. Uh,
100%. Yeah.
and when they're just collecting a check, I mean, I don't know. That's just my take on property management. If for somebody that wants to scale, obviously we're not going to manage 1,000 units if we had 1,000 units. I said I wasn't going to manage over 50, but here I am. But anyway, how do you approach, or what are your thoughts on having multiple streams of income? Because obviously, within the fund, you have multiple streams of income through different investment vehicles. So what's your take on that in just life in general for people listening, and then also in the fund as well?
Yeah, I mean, like you said, I obviously think it's hugely important, right? I started my career just like everyone else with a corporate job, well, not everyone else, but most people with like a corporate job, and had one stream of income, which was fine. But looking back on it, it's pretty risky to just have one source of income. And honestly, the whole idea with buying real estate was to replace my income, right? I'm like,
Mhm.
okay, I make this if I can buy this many units, like the math checks out. It doesn't always work out that way, as we know, right? And I've had to stabilize the portfolio and those costs don't always add up. But kind of back to your question, the fund again is just to have multiple streams of income. I'm a huge fan of just having as many streams as possible, that are at least passive or like I'm semi-passive. Because
Mhm.
if you have too many active lines, then I think you lose sight of what you're really working on. But if you can add passive lines that are truly passive and not like, well, I kind of talk to that guy like once a week, actually passive, to me that's huge because you should like to me you should never rely on one source of income, because if that goes dry, then you're honestly kind of SOL, right? Like how are you going to feed your family? So to me the more the better. As again, as long as it's semi or at least fully passive and not semi-passive. Or I mean, some people kind of conflict the two, but I think you know what I mean here.
Yeah, absolutely. Like rental income is not truly passive income.
Unfortunately, not.
It's not, it's categorized as passive income, like all
Right.
over like the website, on books. It's like, oh, passive income, passive. It's not passive income. Don't get it twisted.
No, but my
Private
fund,
lending. Huh? What was that?
I said, but my fund or like I'm lending, like you said, like that's passive income.
Right.
Give it to someone and they do the right thing. But again, that requires some trust and you have to do your homework to make sure you're dealing with the right people.
Absolutely. You know, finding a trusted individual that has a track record, has a process, has a team that does it on your behalf with your capital, that's passive income.
Right.
But if you're out there just buying deals and managing the portfolio, that's not passive income.
Not
That's
at
just
all.
that's
It's a full-time
active
job.
real estate. That's a rental income for sure.
Yeah.
Um, you know, what are your long-term goals for Epler Capital Funds, and how do you plan to achieve them?
So long-term goals, fully transparent here. The fund is up to about $3 million assets. I mean, my goal, kind of my BHAG is to get this thing up to 50 million by in the next like in 5 years, and up to about 100 million in 10. Um, those aren't obviously steadfast numbers, but this strategy, frankly, doesn't work with it being much bigger than that. Just with the opportunities that I'm seeing now, and this might change as time goes on. But the check size that I'm writing right now is anywhere from $500,000 to $800,000 with these different groups. Um, that can scale to a few $1 million for each of these groups, but much more beyond that. I'm dealing in a different asset class and a different business type. So for me, the goal is to get up to that level. And just with the way the business is, I don't need this to be a multi-billion-dollar fund like a lot of Wall Street firms. Um, I'm perfectly content with this fund being that 50 to $100 million fund. Me still being really involved in kind of choosing those asset classes that we put money into, because to me that's actually the fun part. Like I like looking through these different deals, seeing what's good, what's bad, seeing what's out there. Like that keeps my finger on the pulse. And honestly helping people get income, because a lot of people don't know. It's like, okay, I have 2 million bucks. Like, how am I going to make that last like the rest of my life and not live like this super conservative lifestyle? So I'm helping them, make sure they have the income to do that, and obviously pass them on to their kids. You can keep that portfolio nut there and just kind of like I'm clipping your coupons. Like that's really, I think, like the path that most people should take. Um, so if I'm able to do what I love and look at these different deals while helping people, like to me, that's a huge win-win. So
Yeah. I totally agree. Like your fund is so unique, and like it's positioned right to where it gives you the opportunity as multiple different asset classes within one fund, where
yeah,
a lot of other funds are single asset based, and this gives you the ability to um, if there were a roller coaster, right, to ride the ups and downs of the performance on other assets when the other ones are kind of on the down, which is super fortunate. It's almost like you built a mutual fund within private investments.
yeah, exactly. The only downside with my fund, um, per the SEC, it's a Reg D 506C, not to get technical on this call.
Yep.
Um, but I'm just like, I'm for the audience, you have to be accredited. So I can only take clients on that have a net worth of like 1 million bucks or make 200 grand a year. So that does limit it a little bit, which is tough, and I would love to help everyone. But unfortunately, that's the way the SEC makes us run these things. So
Yeah. So more of the story, go make more money.
that's right.
Yeah. If you don't have a $200,000 income for the last, what is it, two
2
consecutive
years, yeah,
years? Yeah, or a couple of $300,000 or a minimum net
exactly.
worth of 1 million, not
Different
including
licenses
primary
and
residence and all
yeah,
that jazzy stuff.
right.
Yeah. It's funny that they do that though. It's like I understand they're protecting the smaller investor, but at the same time, it's almost as if they're hurting them, right? Because if people had more access to better investments, which are usually private investments, their retirements would be so much easier, right? They're always stuck in the Main Street investments, which these days aren't really always the best for them.
So I don't know what the status of this is now. I haven't followed it, but I did see not that long ago there is some legislation in place that there's a test that non-accredited people can take that gets them that little gold star or whatever you want to call it, that they were actually able to invest in these deals without hitting those thresholds.
Oh,
I
wow.
hope that passes. I think that would be huge for the industry and huge for like most investors. Because like you said, if you look at the top like hedge fund managers and the top endowments, 2/3 to 3/4 of like the overall thing is in private assets, whether it be real estate or different like in private equity groups or things like that. Only a quarter to a third of it is in like the public markets, and most people only know the public markets.
Yep.
So what does that tell you about like where the money should actually be going, right?
True wealth is made in the private markets, which is not attainable, or people can't touch it that are just ordinary people, which is a total
Right.
shame.
It is. It is.
So, Craig, for the listeners who want to connect with you, learn more about your fund, more about your work, what's the best place for them to go?
Sure. I think the best place is website. It's at eplercapital.com. You can email me, craig@eplercapital.com. And you can find anything you need to there. I'm on LinkedIn, on all the socials. So yeah, obviously feel free to reach out if you're interested at all. I'd be happy to talk to you if you have a family member. That's what I do a lot too, is someone say, hey, my parents might be interested in that. I talk to the kid kind of on their behalf. So I'm happy to talk to anyone in that regard.
Awesome, Craig. Well, it was a pleasure having you on Philly Fortune Talks.
Thanks, Jake. I appreciate it.
Thanks for tuning in to Philly Fortune Talks with Jake Penny. Inspired to share your success story? Visit phillyfortunetalks.com/guest and let's inspire together.